Hi, welcome to the corporate finance, and in this chapter, let's talk about the business forms and corporate management. This is a very important introduction of the corporate finance, and we talk about some very important concepts and very basic concepts. What is corporate finance about? We talked about what finance is in the previous overview slides, and for corporate finance we mainly talk about three things. The first one is what long-term investments should the firm take on. That is basically about if the firm is spending money, where does the money go? So it's a problem about money out. So the firm is an organization. It has money in, it has money out, and the money out is investment. Okay. The firms want to invest the money into some area that the money can increase, the value can increase, to have the positive return to get more money back. And the second question is money in. Where will we get the long-term financing to pay for the investment? That's money in. For the money in, we call it financing, okay? And as a corporation, as an organization, how will we manage the everyday financial activities of the firm? Okay, this is called operation. What structure should we have within the firm to manage the money? Not only cash, but also the other financial assets. If we have a very poor operational organization, then we probably will have bad investment and inefficient or very costly financing channels. So we will have very expensive money in and less effective money out. Then over time, the firm will run out of money. And the firm, as an organization, will go bankrupt. Okay? When we have a good operational team, we have cheap money in and efficient, with a high return, efficient investment money out. Then the financial activities will continue and increase the value of the firm. So the important questions about the corporate finance is basically three things: money in, money out, and how to manage the money. Okay. So who is managing the money in the firm? When we are talking about this question, we are talking about the financial managers. The most important top financial manager within the firm is usually the CFO, the Chief Financial Officer. When we talk about the CFO, we are also talking about the basic board structure of the firm, the modern firm. In a modern corporate structure, we have a board. A board of directors is a group of people who are called directors, representing the shareholders or the owners of this firm. You know, when we talk about the finance in the previous slides, the previous lecture, we know that the firms have owners, right? And these owners are proving that they have the ownership by having the shares of the corporate stocks. When they have the shares, they say they are owners. But the firm may have like 1 million owners, 1 million shareholders. So how do they manage the firm? They can't, discuss the firm activities with a big party of 1 million people. So they choose some people or the directors to form a board, okay, to represent them. So these people are called board of directors. Okay, board of directors. And these people are representing the owners. And the owners will choose a management team. They first choose a person, the top manager called CEO, Chief Executive Officer. And the CEO will form a group of team managers, including CFO. CFO is usually the second most important person in this management team because the CFO is managing money, and also CMO, Chief Marketing Officer, responsible for the sales of the products, and also COO, for example, daily operations. They have this Chief Operational Officers, and a lot of O's. We usually call them CXOs. A funny thing about the CXOs is that there are some, every firm has a CFO and a CEO, but some firms also have interesting positions such as CSOs. You probably think CSO as Chief Strategy Officer. Yes, Chief Strategy Officer is also a very common position to study the future direction of the firm. But also another chief CSO is called Chief Storytelling Officer. That is to form the historical events of the firms, to form a good story to increase its public image of the firm. For example, Alibaba has a CSO. Microsoft has a CSO, Chief Storytelling Officer. It's also a very important position, but it's not in every firm. Usually in technology firms, they also have the CTOs, Chief Technology Officer. In some other firms, it's also called CIOs, Chief Information Officers. They're responsible for the informational and technology things. When we are talking about the CFO usually act as two roles. The first is the treasurer. The treasurer is overseeing cash management, about the cash. How do we manage the cash? The very important function of the CFO is that he or she should not make the firm bankrupt. Well, it sounds like a very easy thing. So if we just have enough cash, then the firm will not go bankrupt. But actually, it's not that easy, because you need to use the cash to invest in some short-term investment to get some positive returns. You also need to borrow a lot of money, the debt from the banks and the other channels, And from these channels, you have to pay the interest. So you need to manage every interest payment and the duration of every investment. If you get a shortage of the cash, or you fail to pay the debt, the principal, and the interest of one debt, then the firm is possible to go bankrupt. Okay, a lot of large firms, they have a lot of assets, but just for a very short period of time, they just ran out of cash. Then they go bankrupt. What is the definition of bankruptcy? You do not have enough money to pay your debt. Even you have a lot of money, but for that money you invest in some area, some target, but you do not have enough cash to pay for the outstanding debt, then your company can go bankrupt. So this is a very technical position, CFO. So as a treasurer, the CFO needs to oversee the cash management, credit management. Credit is the debt that you borrow from the other the credit providers. Also, as a treasurer, the CFO needs to oversee the capital expenditures, where to invest the money. The capital expenditures usually include, for example, the PP&E, the plants, the properties, and the equipments. So the net PPE is accumulation of the past capital expenditures. You spend the money, and the money should, you see, in other cities, the government can do the capital expenditures, and the capital expenditures will be reflected by the roads, by the buildings. So as a corporation, you also invest in the buildings, the equipment, such as this computer. So they should be reflected by the PP&E. The CFO is also responsible of financial planning. For example, in 1 month, where should we invest our money? where should we finance our next year's money? We need to invest in another big project next year or maybe in 9 months. Where do we get the money? So this is what you need to, what the CFO needs to think about. As a controller, the CFO also needs to oversee taxes, cost accounting, financial accounting, and data processing. Basically, the financial management team has two decisions. Simply speaking, money out and money in. The money out is also called capital budgeting. What long-term investment or projects should the business take on? Should I use the money to invest in building a plant to produce more masks during the pandemics? Or should I put the money into some banks that, and the bank as financial intermediates, they will lend my money to some other people and oversee their operation? Or should I use the money to acquire a competitor firm? Or should I use the money I just reserve the money, hoard the money as the cash to prevent for the future uncertainties? That is called the precautionary savings. Precautionary savings. Okay. So where should I spend the money? That is the investment or capital budgeting. About financing, it has another name, capital structure. Simply speaking, where should I get the money? Should I issue debt or should I issue equity? We talked about the difference between debt and equity in the past, in the previous lecture. If I use debt to finance my investment, that means I borrow money from other people and I issue debt as a financial security to the debt buyers. And this is a low risk, low return financial asset for the debt buyer, because if I gain money, if I have a very high positive return, I need to give them the principal plus interest. If I go very bad in business, I still need to pay for the principal and interest. If I decide to, as a firm, if I decide to finance my firm investment through equity, I'm actually selling my ownership. So this is a high risk and high return, relatively high risk and high return investment for the equity buyers. The very common and usually, like I think all of you have heard about it, the sale of equity through the IPO. Okay. Instead of IPO, there were some private offerings. For example, I don't have to do the IPO to the public. It's an initial public offering to the public, to a lot of people. I can instead just contact two friends and say, hey, if you want to buy our equity, our ownership, if you're interested in our firm's financial assets, maybe you can just pay me $100 million and I give you a 20% ownership. So my equity ownership will decrease from 100% to 80%. Okay, and they will be the outside owner or the shareholder of my company. That is capital structure. Where should we use debt or equity? In the later part of the semester, we will talk about the difference and the subtle things about the capital structure. That is the MM theory, Modigliani and Miller theory. But that will be in probably 10 weeks. So corporate finance is about money in and money out and the management of the money. There were three forms of business organizations. Well, there were more forms, but mainly speaking, there were three major forms. The first one is called sole proprietorship, and the second is partnership. The third is corporation. We often heard about the firms, companies, corporation. We usually treat them as the same thing, but they have some subtle difference. The very simple one, the business form is called the sole proprietorship. Simply speaking, it is a one-man firm. One-man firm. This firm has just one man, one owner, just this person. It is registered a company, a firm, and this firm has only one owner. Remember, this firm does not have to have shares, and usually it doesn't. Think about the street food along the street. If you see one store, one restaurant with one owner, that's probably a sole proprietorship. Okay, so that restaurant has only one owner. That is the restaurant owner. The advantage of this form of business is that first, it's very easy to start. You register with the with the government, probably just cost you one day, and this business can be set up. And it's the least regulated because you just have the appearance of the form of a firm or a company, but instead, the core of this firm is just one person, the owner. So it's also treated in the tax laws and the government is treated as one person. Although it's not rigorously, it's not a natural person. It's a firm. It's a business. But the business is tied or is almost equivalent to one person. So it's least regulated. You just need to report to the government and, hey, this restaurant still exists, that's all. And the single owner keeps all the profits. If the restaurant makes money, all of the profits will belong to this one man. Most importantly, this firm will be taxed once as personal income. Why is this important? Because if a business is registered as a corporation, the corporate profits will be taxed once, for the first time, at the corporate tax rate. Okay, in many countries. And after being taxed at the corporate level, the profit will be distributed to the shareholders as a dividend. And when the shareholders have the dividend payments, the dividend will be taxed again at the second time at the personal level. So it has a double taxation problem. Well, as a sole proprietorship, for example, a restaurant, the business does not have to be taxed twice. It's only taxed once. Of course, if you have the advantages, you have the disadvantages. First, the business lifespan is very short. Well, it may not be very short, but it's limited to the life of the owner. If the owner dies, then the business vanishes. Secondly, the equity capital is limited to the one man, the only owner's personal wealth. If this person wants to make a chain restaurant, it is very difficult for him to do this because he himself only has his own one man's money. He doesn't have enough money to set up so many chain restaurants. So the expansion of this type of business is limited by this owner's personal wealth. And also importantly, it has unlimited liability. For example, if this businessman, this owner, makes a mistake in business and loses a lot of money, he will have to use his personal wealth to compensate for the loss. For example, he invested $1 million for this restaurant. But somehow, this restaurant, for example, due to the pandemic, he lost $5 million. Now he will have to borrow another $4 million or sells his house or do whatever things to compensate for the extra $4 million. So this is an unlimited liability. And it's very difficult to sell the ownership. It's just a one-man business. You can't cut your business into, if you want to cut your business ownership to, say, 100 shares and sell 20% of your ownership, then your firm will become a corporation or shareholding company, not just a sole proprietorship. And you have to change the form of this business. As a sole proprietorship, like a restaurant, you cannot easily sell your ownership. Okay. This is the first form of the business. The second form is relatively similar to the sole proprietorship. It's called partnership. The only difference is that it has not only one man, it has more than one person, but not too many people. Maybe 2 people, maybe 5 people, but not too many. It's called partnership. The owners are called partners. They're not shareholders, they're partners. Okay. This form of business also has advantages. For example, more capital available relative to the sole proprietorship. It's relatively easy, not the easiest to start, but relatively easy to start this business. Again, the income is also taxed once as a personal income. The disadvantages are similar to the sole proprietorship, that is, it has an unlimited liability unless one of the partners is a limited partner. Right now, in many countries, the laws allow the partners to have the limited investment, the limited liability investment. For example, if you have like 4 partners and 3 partners are running this restaurant, and for one partner, he says like, I just want to invest in $2 million. If you make a lot of money, just give me some shares. And give me some, to be very rigorous, it's not called shares, just give me some or some part of the profits. If the business fails, then the most amount of money that I lose for this business is the money that I invest in. So for this partner, it's called limited partner. And for the other 3 partners who are responsible for all the losses that potentially can be made, they are called general partners. Okay. Partnership dissolves when one partner dies or wishes to sell. Remember that if just one of the 4 partners wants to sell his ownership, then this partnership will go away, and another partnership will form. For example, we 4 have the business, and I want to sell my portion, my share to, it's not really the stock share, but my partnership to another person. Then instead, our partnership will dissolve, and you 4 will form another partnership. Again, it's also difficult to transfer ownership. So compared to the sole proprietorship and partnership, the corporation has very obvious advantages. First, the liability is limited. If I invested $2 million into this business, and then the corporation goes bankrupt, the upper limit of my investment loss is $2 million. The corporation has an unlimited life because the corporation has a stock shares, and if I want to quit this business, I just need to sell my shares to another person, and that person will become another several persons. So they will become the shareholders, and the corporation can still exist. There is a separation of ownership and management. As a partnership or sole proprietorship, the owner is also the manager. In the corporation, the shareholder can ask some big shareholders to form a board of directors to represent them, and this board of directors will choose a management team, including CEO, CFO, CMO, COO, and C whatever O's, to help manage the firm. If I think these management people, they're not managing my firm well, what do? I vote by go away. I vote with my feet. Okay? I just sell my shares. I don't have to talk with them and say, hey, do it well, you should do this way, you should do it that way. No, I don't have to do this. I just sell my shares to other people. So the transfer of ownership is easy. And it's much easier for a corporation to raise capital because the corporation has a very important financial asset. That is its stock shares. So as a corporation, you can put your shares, your corporate shares, the treasury shares, to the bank as collateral. And the banks can lend money to you. So you have the treasury shares as the collateral, as the financial asset. So it's easier, it's also easier to raise capital because you can increase your shares. You can issue more shares to additional shareholders to raise more money. It has so many advantages, of course it has a disadvantage. Otherwise, all of the businesses will choose corporation. The disadvantage is the double taxation that I explained a little bit before. So the income of this firm, this corporation, for example, this corporation sold 20 million or 30 million value, $30 million of shoes. And the cost of making these shoes and all the management expenses, everything together, is about the 20 million. So the profit is $10 million. And for these $10 million, it will be first taxed at the corporate level. Okay, let's say 30%. But now it's much lower after Donald Trump goes up enter the office. It's much lower. Let's say it's some fantastic country. It's 30%. Then you're left with $7 million. And when you distribute this $7 million as dividends to the shareholders, the owners of this corporation, the $7 million will be taxed again. Okay, let's say another 30%. So you will pay another $2.1 million, and you are left with $4.9 million. You have $10 million. If you have a 30% corporate tax rate and 30% personal tax rate, then the final amount of money as a shareholder to get from a $10 million profit to $10 million profit is only $4.9 million. Okay, this is its disadvantage. When we talk about the corporation, sometimes when you search the corporations over the Hong Kong Stock Exchange, these are called listed corporations. You know, corporations have the private corporations, listed corporations. Listed corporations are also called the public corporations. The private corporations, their shares are not traded publicly. For example, for a private company stock, if I want to buy their shares, I have to know someone, some owners of this of this company. I have to contact them. I have to talk with them. There is no public platform for their shares to be traded. After the initial public offering, after the IPO, the corporation can list their shares on a exchange. So exchange institution that we discussed it before in the previous lecture. The exchange provides a platform for the publicly listed shares to exchange between, to be sold and purchased between the buyers and sellers. So as an outsider, if I want to buy their shares, I can log in to my brokerage account, and go into this stock exchange and look for these shares and see the market price. If I love the market price, I think if the market price is cheaper than I expected, I can just use the money to buy this share. Okay, these are called the publicly listed firms. So if you log on the US, the New York Stock Exchange or the Hong Kong Stock Exchange or Shanghai Stock Exchange website, you check the financial statements of these corporations, for example, the balance sheet or the cash flow statements. On the first page, on the cover page, you will see the incorporation and headquarter of a corporation. Remember that the two concepts have Not subtle, but huge difference. Incorporation is kind of like registration. You register the form, or you say you incorporate this firm, this corporation somewhere. For example, Alibaba is incorporated not in mainland China for taxes purpose and stock listing purposes. A lot of Chinese firms are not incorporated in mainland China. China Mobile is one of the largest telecom providers in mainland China, but it's incorporated. If I remember right, it's incorporated. Correct me if I'm wrong, but I'm pretty sure several years before it was incorporated in Hong Kong. Okay, not in mainland China. And a lot of Chinese technology firms, they are incorporated in Cayman Islands, BVI, and other offshore financial centers. The headquarters are like the main location where your stuff, where your this corporation's workers walk in. So it's kind of like a family, a couple. They register their marriage somewhere, but they live in other places. For example, as a couple, you can marry in the Philippines or Ireland, but you live in China. So it's kind of like, as a corporation, you incorporate in Philippines or Ireland, but you headquarter in China. Alibaba, of course, is headquartered in Hangzhou. Okay. We have millions, dozens of millions, or thousands of millions of corporations around the world. Some corporations, some industries have, in some industries, their corporations are very large in terms of assets, in terms of market value of the stocks, in terms of number of employees. And some of the corporations are usually small. So the industries of the largest corporations include oil, banking, telecom, electronics. If you read the list of largest companies by revenue over Wikipedia page, you will find out it's a very clear trend. And be careful to use Wikipedia's info. This web page's information is generally accurate, but when you're doing serious and rigorous research, to avoid using Wikipedia's information, because it's not carefully checked by the professionals. So use Google Finance or Yahoo Finance or some professional databases. The professional databases include CompuStat. For the North American firms, you use CompuStat, or for the Chinese firms, you use WIND. Okay. And there were some other professional databases provided by professional data providers. Well, these industries, oil, banking, telecom, and electronics, these industries generate largest corporations for some reasons. The most important thing is that in these industries, they either have a very, very high threshold of entry. For example, oil. If you don't have several billion dollars, it's really hard for you to develop the equipment to drill the oil. And they have the economy of scale. Okay, the economy of scale. When you have a larger network in banking, in telecom industries, if you have a larger network, it's easier to expand to a even larger network, because your marginal cost will be lower. So in these industries, the marginal cost of expanding your business is relatively small, and the fixed cost of setting up the business is pretty high. Okay. It is also true for the internet companies. In China, people use Tencent, WeChat, or QQ. The marginal cost of adding one user is almost zero. For China Mobile or the almost every telecommunication company around the world, the marginal cost to serve one additional user is almost zero. But setting up the whole network is very costly. So in these industries, it's very easy to produce a natural monopoly. And usually the governments will use antitrust laws to break them into several big companies. And these several companies, big companies, are called oligopolies. Not monopoly, but oligopolies. So a very brief comparison of the different forms of business organization. That for the sole proprietorship, the lifespan is limited to the life of owner, and for the partnership, the life will end if one partner dies or sells his stake, while the corporation has an unlimited life. Proprietorship and partnership have unlimited liability unless the one partner is a limited partner, while the corporation has limited liability. The proprietorship and partnership owners face difficulty to transfer their ownership, while the shareholders of the corporation find it relatively easier to transfer their ownership by selling their stocks. To finance their investments, proprietorship and partnership, the owner of the proprietorship find it most difficult because he has to rely only on his own wealth, but the partnership business relies on the several partners' wealth, while the corporations find it relatively easier to raise capital by issuing more equities, or use their treasury equities as collateral to raise more debt, to raise more money while issuing debt. So we talked about the board of directors, the management, the CEO, CXOs. So they are the operation, and we talked about a little bit about the investment, but that will be the most important part of the first half of the semester. We will talk about how to evaluate the value of different investment targets. And we will use the second half of the semester to talk about the corporate structure, the cost of financing via different channels, issuing debt or issuing equity. So basically talk a little bit, the brief introduction about the operation, money out and money in. Okay. And let's get back to the fundamental question. What is the goal of financial management? So you're managing money. For what? What should be the goal? You know, I personally believe that any goals or any, a lot of things in the universe are meaningless because the universe is too huge and human lives are too short, and corporation, even the Earth, does not exist. The galaxy does not exist. The universe will not feel anything, because there are like 100 billion galaxies in this universe. So we make the goal for anything. We humans make things meaningful. So what should be the goal of a corporation? Should we maximize the profit? Should we minimize the costs? Or should we maximize the market share of our products? Well, a Chinese firm, Gourmet, was, if you're interested in business history, you can check about like 10, 15 years ago, you can check that the Gourmet's management team, they had a fight over the ownership, the control of this firm, because they have a different ideology of the goal of the corporation. One side of the managers, they believe the goal of this corporation is to maximize the shareholders' profit, while the other side of the managers, they believe the goal of Gourmet is to maximize the market share. So they had a fight. It's a very classic case. You should, if you're interested, you can check the online materials. Or to maximize the current value of the company stocks, the market values. Well, the market value, simply speaking, is equal to the number of stocks multiplying the price, the current trading price of the company stock. What should be the goal? There is not a universal answer for this. Like I explained a little bit in the past in the past lecture. In Anglo-Saxon culture, the purpose of a corporation is to maximize the utility, in economic terms, the utility of the shareholders. That is the value or the profit, the value of the stocks, okay, the market value of the stocks. But the market value of the stocks is determined by the profit. So the purpose or the goal of a corporation is to make the corporation as profitable as possible. This is an Anglo-Saxon view, including this culture is in the British firms, at least the classic British firms, American firms, Hong Kong firms, other British culture influenced firms, because we currently use a lot of American textbooks, because there are a lot of good American financial economists. They write very good textbooks. So we use their textbooks, and these books, they assume that the goal of financial management is to maximize the profit of the corporation. But it is not a universally accepted concept. For example, in Japan and Germany and some other countries, they believe that the corporation's goal is to maximize the utility or the welfare of the stakeholders, not the shareholders. Stakeholders include the shareholders, the owner of the corporation, the employees, the related parties, the customers, the society. Okay. Everyone is related with this corporation's business and products. They believe that they should take care of everyone. And it has some concepts of the socialism. There is something about the socialism within this belief. Okay, which is good, which is not good. There is not an answer, because for good or bad, we have our own judgment. In terms of corporate profit, of course, the Anglo-Saxon view is good. But in terms of social welfare, probably the second one is good. The economists are debating, but I think it's more about the subjective view, not the objective view. It's all your personal judgment. Okay. If you think that corporation's goal is to maximize profit, doesn't mean that we should do anything and everything to maximize owner wealth. Do we want to lower the quality of our products to save the cost and enhance our profits? Because you know what, like if you want to sell a product to your customer, right? If you just lower the profit a little, if you lower the quality of the product a little bit, many customers will not feel the difference, because there is a information asymmetry between you and the customer. You are the maker you are the producer of your product, and you know your product the best. So should you, even in the absence of the customer's awareness of the true quality of your product, should you make a lot of investment of the technology to improve the quality of the product and provide the best quality product to your customer? If you believe that the corporation's goal is to make profit, you should not do so. Because, if the customers do not realize that you spend a lot of money, if they do not realize that the quality is good, why do you spend money to make the quality good? You don't have to do so. But if you think that the customer's welfare is also a part of the corporation's goal, you should think about making the product quality better with your cost, the corporation's shareholders' cost, but to make their life easier in the future. Because the customers probably they use this product for 5 years, and they don't even remember where they purchased this your product. They still find the product with good quality. It's their welfare. It's the social welfare. Should you use the corporation's money to increase their welfare? This is all about your belief of the goal of a corporation. Okay. There is a research area in corporate finance called CSR, Corporate Social Responsibility. Or recently it has another name, ESG, Environmental, Social, and Governance. In the CSR literature and research, well, CSR is more and more popular among professionals and among academics about why firms should do CSR and whether the firms want to do CSR and what kind of benefits and costs do the CSR activities give the firm. So there is a sub-item of the CSR evaluation that is a product quality. And the CSR, the corporate social responsibility ideology, is more related with maximizing stakeholders' welfare. This kind of belief and ideology. Now we talk about the agency problem. This is within the corporation's or the company's management. Agency problem is one of the core concepts of corporate finance. Okay. The agency relationship arises when the principal hires an agent to represent his or her interest. Who's the principal? Who's the agent? Simply speaking, A wants B to do something for A. Then A is a principal, B is an agent. How does A persuade B to do something for A? Usually in the labor market, you pay money, right? For example, the school pays me to teach you. So the school is a principal. I am the agent. And I use the school's resource to hire my TA, the teaching assistant, to tutor you, the students. Then I am a principal and the TA is an agent. There is a clear conflict of interest between the principal and agent when their interests are not completely aligned. For example, the stockholders or the owners of the corporation, they are the principals. They hire the managers who are agents to run the company. What do the principals or the stockholders want the agents, the managers to do? They want the managers to work as hard as possible to increase the shareholders' value or the share value, and to minimize the cost. But for the managers, their utility function has several parts. First, they don't want to minimize the cost. For a manager, I want to spend the cost because the cost is my utility. The shareholders want the managers probably to take taxes, but the managers want to have the private car or maybe private jet, okay, to save his time and make his life easier. The principals want to use the lowest cost amount of money to ask the managers to do things, but the managers want to have as high salary as possible. The principals want to have agents to work 24 hours a day. The managers want to sleep at home and still get the money. Okay, so this is a clear conflict of interest. And this conflict of interest is within every corporation, every firm, every organization, and every society. There are more broad concepts about the agency relationship. For example, the government. What is the government? The people want the government to provide a good life for the people. So they want the government to have the least corruption, to use the taxpayers' money to serve the people. But this is your wish. Every government, for every organization, when you have the agents will not serve perfectly the principles. They will serve their own. They will maximize their own utility function. They will serve their own interests. For example, in every country, every government, there is corruption. Every country. And there is almost corruption in almost every company. For example, the company wants hires you to purchase the materials, the raw materials. The company wants you, the company pays you, and they want you to spend 40 hours to cut the price to the lowest. But cutting the price to the lowest by spending 40 hours, you still get the same salary. You probably, what you want is to just ask for the price and say, hey, the company will pay you, and done. Then you can go home. Okay? So you want to save your time. You want to make your work and life easier. You don't always, when you're hired by a company, you don't always want to serve the company's interest. Okay? You see this kind of cases every day, everywhere. So the agency problem arises because the agents have costs to do things that the principals want them to do. And the whole kind of conflict of interest cost a management and supervision cost. That's called agency costs. So the agency costs have a very simple alternative name that is called how to manage the managers. How do you manage the managers? How do you supervise the managers? The theory, the fundamental theoretical solution is to try to make the management's interest more aligned with the stockholder interests. For example, if you want the managers to work harder, you give the management team shares to let them know that when they are working harder, when they are creating value for the shareholders, their own value, the value they themselves get will also increase. But does it perfectly resolve the agency problem? No. Why is that? Because, for example, you are the shareholder, you have 100% stocks, and you give the managers 5% shares, no more. Okay. And when the managers spend a lot of time and energy to deal with things, they know that when they create $100 million value for additional value for this company, you as a shareholder get $95 million. They get only $5 million. If that effort will cost him $50 million, he will not do that. Or though you want them to do this, but they will not do that. But this will at least make the management and stockholder interests more aligned than not giving them any shares. Or some companies will tie the management bonuses and salary with the performances. For example, if by the end of this year our stockholder, our stock value is above which level, your bonus will be 1 million more, something like this. All of this is to give the managers more incentive to work harder, to think from the perspective of the shareholders, not from the perspective of just the managers themselves. Okay. And And the incentives needs to be structured carefully to make sure that they achieve their goal. For example, how many percentages of the shares you want to give to the managers? 1% or 2% or 5% or 10%? Or how many options do you want to give the managerial team? Okay. And also, the threat of a takeover may result in better management. A takeover is one company purchasing another company. Why does a firm want to purchase all of the shares of the other firm to gain full control of another firm? Well, this is a big topic. This is called M&A, merger and acquisitions. So researchers have a lot of discussions and research about positive research about the reasons why a firm wants to purchase another firm. But one reason is that the acquirers who spend money to purchase another firm feel that the target firms, the firms that will be acquired, the target firm's management is too bad. So remember that in the Proctor lecture we talked about the LBO, leverage buyout, which is a kind of private equity. Okay. The leverage buyout is that a good management team, they feel that a firm has a lot of good assets, but the firm is being managed by a bunch of incapable people. Incompetent people, the manager, they're managing the firm poorly, and a group of acquirers, they want to acquire this firm, and they think by managing this firm in another way, the workers will work harder, and the value of the firm, and therefore the shares of this firm will go higher. So they can gain profits by reselling the firm with a higher value, okay, that they purchased with a lower value. And this threat of takeover will result in better management because the target firm's management team will feel a threat. If the managers are managing these firms poorly, the owners of this firm will threaten them, saying, if you are not managing this firm in a better way, we will sell this firm to another group of owners. And this group of owners will fire all of you guys, and you will not have any benefits that you previously gained from this firm. If you're not working hard, we will sell this firm, and they will fire you. And because you have a very bad historical record, nobody will hire you again. So this is a threat. So the current management team probably will feel the pressure and spend more time and effort to improve the value of the firm. Okay. Also, you can have the other stakeholders who help manage the managers. Well, this is the end of this simple chapter. It's about the different forms of businesses and the agency problem, the board of directors, and the principle, the basic and brief introduction of the goals of the corporation management. And there were some quick quiz questions that will be discussed in the tutorial session by the TA. Okay, thank you very much, and we will see you in the next chapter.